Hello, everyone, and welcome. My name is Kevin Dooley. I'm a manager in Raymond's Business Valuation Group. Today, we're here to give you a clear and approachable introduction to business valuation, what it is, why it matters, and how the process works. So I'll be walking through the anatomy of a valuation and the key valuation methodologies. My colleague, Gus Robito, will discuss why valuations are needed, the normalization process, and the key drivers of value. Now let's get started.
There are many reasons why someone needs evaluation. Specifically, one major category is tax-related purposes, such as estate and gift tax planning, Section 409A valuations for stock-based compensation, or converting from C Corp to S Corp status. Another major category is transactions in financial reporting. We perform valuations for mergers and acquisitions, recapitalizations, and financial reporting under ASC 805 for purchase price allocations, or ASC 350 and 360 for impairment testing. We also assist with litigation support and buy-sell agreements. Ultimately, valuations provide clarity, compliance, and confidence, whether ownership is changing, taxes are involved, or strategic decisions rely on accurate value.
Now let's go through an anatomy of evaluation. Step one is to define the purpose and the scope of the valuation, understanding what is being valued and why, and establishing the standard of value. Step two is gathering relevant data. This includes financial statements, operating documents, and industry and economic information to better understand the business's context. Step three is identifying potential normalization adjustments. This includes owner-specific expenses or non-recurring events, and Gus will expand on these adjustments shortly. Step four is analyzing the company. This includes both qualitative analysis and quantitative analysis. From a qualitative perspective, we look at things like management strength, competitive position, and risks. And from a quantitative perspective, we look at it from historical performance, margins, and growth. Step five is to select the appropriate valuation methods. We look to determine whether we're going to use the income approach, the market approach, the cost approach, or a multitude of approaches. Step six is applying those valuation methods selected. Step seven is going to be to reconcile and conclude on those valuations, or the value rather. Step eight is to prepare the deliverable. When we prepare our exhibits, we then meet with the client to discuss the valuation and make sure that they have a clear understanding of what was driving the value of their company.
Normalization adjustments are a critical part of the valuation process. These adjustments help convert accounting financials into economic financials, reflecting the business's true ongoing performance. Some common normalization adjustments include adjusting owners' or officers' compensation to industry levels, removing one-time or non-recurring expenses, correcting related party transactions like rents or management fees, LIFO to FIFO inventory adjustments, and tax affecting pass-through entities where appropriate. We also evaluate non-operating assets and liabilities, such as related party loans, investments, or life insurance cash values, and determine if working capital levels are excessive or insufficient. All these help ensure that the valuation reflects the real, sustainable economics of the business.
Now let's go through the valuation approaches. First, we'll cover the income approach, which is based on the premise of future economic benefits the company is expected to generate. The first income-based approach is the capitalized cash flow method, and this method is most applicable when a company has reached a stable, predictable earnings stream. The second approach is the discounted cash flow method. This method allows for more flexibility to project potential uneven or expected changes in the future cash flows and then discounting them back to present value. The income approach is especially appropriate for established, profitable companies that can yield either a controlling or minority level of value depending on the adjustments being reflected in the cash flows. Next, we'll cover the market approach. The market approach compares the business to real-world data from comparable companies or transactions. We develop valuation multiples based on those comparables and adjust for differences in size, growth, profitability, and risk. This approach can also result in either a controlling or minority level value based on the nature of the data being sourced. Lastly, we'll cover the cost approach. The cost approach is most relevant for asset-heavy or distressed companies and is based on the principle that a buyer will not pay more than the cost to replicate those assets of the business. This typically results in a control level value since it assumes the owner can sell and liquidate the assets.
All right, some key drivers of value include profitability, growth, utilization or turnover, leverage, and liquidity. For profitability and growth, the stronger margins will enhance the value, and same thing with the growth. If you're sustainably growing, that'll increase your value. In terms of utilization or turnover, an asset-light business will generate stronger returns. And for leverage, the optimal use of debt can lower your cost of capital, which will then increase the value of your business. Same thing with liquidity. Stronger liquidity reduces risk and raises value.
As we wrap up, we hope this gives you a clearer understanding of how valuations work and why they matter. Our key takeaways from today's discussion include: it's never too soon to start planning. Early planning gives owners more options and better outcomes. Number 2 is understand how the market and the industry views your company. Valuations reflect market expectations and not just internal performance. And the last thing we'll leave you with is know the key drivers of value in your business. Every business has unique levers. Understanding them helps guide better strategic decisions. If you'd like to explore the value of your business or start planning for the future, our team at Rehmann is here to help. Thank you for joining us.